Hello and welcome to my channel Making Money and Finance. I have a new video for you today. We'll discuss the stock market investment, and we'll try to address the question, between index and mutual funds and ETF, which choose? Before I begin, I want you to hit the like button, leave a comment, and subscribe to our channel so that you are the first to know when we upload a new video. And if you find our video useful, please share it with your friends and family. There are many other kinds of investment vehicles, such as index funds, mutual funds, and exchange-traded funds, ETFs, which enable investors to pool their money together and invest in a diverse range of assets. However, prior to making any investments, you need to have a solid understanding of the key differences that exist between these three categories of funds. In this video, we will compare and contrast index funds, mutual funds, and exchange-traded funds, ETFs, so that you may make an educated choice regarding the sort of fund that is most suited to meet your financial needs. Index funds are a sort of mutual fund that invest in a collection of assets in order to mimic the performance of a specific index. One example of this would be the S&P 500. Index funds are examples of passive investments, which means that unlike other forms of mutual funds, they do not need to be actively managed by a financial professional. Exchange-traded funds, often known as ETFs, are very similar to index funds in the sense that they replicate the performance of a specific index or basket of assets. ETFs, on one hand, are traded on an exchange much like stocks are, which means that buyers and sellers can transact with them at any time during the trading day. On the other hand, mutual funds are not traded on an exchange. Rather, buying and selling can only take place once the trading day has come to a close. The management of these things is the primary distinction. Mutual funds are not exchanged on an exchange, whereas exchange-traded funds, ETFs, are. Since ETFs can be traded in the same manner as stocks, exchange-traded funds are traded on exchanges. They can be traded intraday, which refers to trading that takes place during normal market hours, just like stocks. It is not possible to trade mutual funds exclusively solely on their net asset value at the end of each business day. Because most mutual funds are actively managed, which means that there is a portfolio manager and typically a team of analysts of human beings doing most of the decision-making to choose what these funds invest in. This means that they need to be compensated for that work, which means that you will typically end up paying higher annual fees with mutual funds compared to an ETF. Therefore, if we go to the expense ratio section, ETFs are going to be lower, and mutual funds are going to be high. Owing to the fact that the majority of ETFs are managed in a manner that is known as passive investing, the expense ratios, which refer to the total amount of fees that you pay on an annual basis to own these assets, can be extremely low cost or even completely free with some ETF. The expense ratio for actively managed mutual funds typically ranges from 0.5% to 1% on average. And generally 1%, while some are significantly higher and can reach the maximum allowed. To 2.5%, while for passive index funds, the percentage is rarely higher than 2.5%. However, some of these are 0% up, and they can be up to the higher percentages, but on average you're looking at 0.2%. That's a big difference. If you have Vanguard's total stock market ETF, which has an expense ratio of 0.03%, this means that you only pay $3 a year in fees for every $10,000 you have invested in the fund. It may not seem like a lot, but once you reach $1 million in that portfolio, those numbers turn into $300 per year with the 0.03 option and $7,500 per year with the 0.75 option. With ETFs, the transparency is very high. With mutual funds, on the other hand, it is typically lower due to the way in which they are regulated. Additionally, the dollar amount minimum to be invested is very low. With fractional shares, you can buy $1 worth of an ETF. There is typically a required minimum investment amount in order to purchase shares of a mutual fund. What is a mutual fund with thousands of dollars in it, and mutual funds in general? The solution can be found in the definition of the term mutual fund. The term mutual fund refers to a type of investment vehicle that pools the capital contributed by multiple participants who act in concert to pool their resources. Because purchasing and selling of assets is the purpose of this money, investing in a mutual fund allows you to participate in this activity. When you invest in a mutual fund, as opposed to buying shares of individual firms, you are investing in the fund itself. As an example, with Microsoft or Amazon, but you're actually buying shares of the actual company, meaning mutual fund company itself. Therefore, investors buy and sell their holdings in mutual funds at a certain price, which is the net asset value. The net asset value is the version of a mutual fund that represents a fund's per share market value comparable to a stock share price. The net asset value is calculated by dividing the total value of all the cash and securities in a fund's portfolio minus any liabilities by the number of shares outstanding. There is a wide variety of mutual funds available, including fixed income index balanced money market, foreign specialty funds, and many others. There's a good deal of them out there. Mutual funds offer a number of benefits, the most significant of which are their extensive diversification, their professional management, their wide selection of investment options, and, in some cases, their low entry barrier in terms of the minimum amount that must be invested, which, in some cases, may be as low as $1,000 or $2,000. The primary drawbacks of investing in mutual funds include the high fees, the lack of ETFs coverage in most situations, and the difficulty in comparing similar funds to one another, as one would do with equities. Again, mutual funds do not trade on exchanges as normal stocks and ETF do. However, what exactly is an ETF? Exchange-traded fund is a sort of asset or security that follows an index sector or a particular investment style. Let's imagine you want to trade stocks and decide to buy an exchange-traded fund, ETF. A single share of an ETF can hold hundreds or even thousands of distinct assets, such as publicly traded firms, which means you'll be investing in a diverse range of companies. Holding hundreds or even thousands of stocks through the ownership of a single ETF. An exchange-traded fund known as VIII attempts to replicate the performance of the U.S. total market index. It is handled in a passive manner and has a total of 4,100 different stocks, with an expense ratio of only 0.03%. Because it is traded on an exchange in the same way as stocks are, an investment vehicle known as an exchange-traded fund, ETF, was given that name. Because they trade intraday, one of the advantages of holding an exchange-traded fund is that, in comparison to mutual funds, ETFs are more liquid, which means that it is simpler to buy and sell them at any time throughout the trading day. Keep in mind that the normal trading limit for mutual funds is just once per day, at the close of the market. ETFs are able to be traded within the standard operating hours of the market. There are many different kinds of ETFs, including bond ETFs, stock ETFs that focus on a particular industry or sector, ETF commodities, ETF currency, and ETF inverse. The most significant benefit of investing in an ETF is increased exposure to a broad range of companies operating in a variety of markets. There is a low expenditure ratio, there are low fees, there is a large amount of diversity, and there is also the possibility of investing in a certain industry. What exactly are index funds, though? In reality, an index fund is really a subcategory of mutual funds and/or exchange-traded funds, ETFs. A portfolio of stocks or bonds designed to imitate the performance of a market benchmark is known as an index fund. Regarding a particular market index, if you wanted to imitate the performance of the S&P 500, you could do so by investing in a type of index fund called SPY index funds. ETFs, in comparison to managed funds, have expense ratios and fees that are lower. With index funds, rather than a portfolio manager actively selecting companies for the portfolio, this manager will design a portfolio that attempts to match a specific index and will do so passively by producing an index fund. Index funds are an alternative to actively managed portfolios. Mainly due to the fact that the index fund managers are merely trying to replicate the performance of a benchmark index. They do not require the assistance of research analysts or any of the other individuals that are involved in the process of selecting stocks. A fund that follows the Dow Jones Industrial Average, which is itself an index, would invest in the same 30 firms that are included in that index in order to replicate its performance. Therefore, one of the primary benefits of index funds is their extremely low risk, diversity comparable to an ETF. Their expense ratios are rather modest. They have impressive long-term returns that have been recorded, documented, and demonstrated. They are an excellent choice for investors who prefer to take a hands-off approach. Index funds, on the other hand, have the disadvantage of the fact that they are susceptible to severe market downturns. There is no involvement of humans, and their profits are restricted to the individual index, for which they are attempting to copy or recreate data. Index funds or exchange-traded funds, ETF, are almost always sufficient for the majority of passive investors. There are some individuals that advocate for mutual funds. Nevertheless, when it comes to the outcomes and the historical performance of the funds, neither of these factors are reliable indicators of the fund's potential future performance. Therefore, you should anticipate paying greater fees if you invest in actively managed funds. If you learned anything from this video, please share it with a friend, press the like button, and subscribe below if you haven't already. Thank you so much, and remember, we're in this game to win.